What is dollar cost averaging? Dollar cost averaging, or DCA, is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of the asset's price. Instead of trying to time the market with a large lump sum investment, dollar cost averaging spreads your investment over time. For example, investing $500 monthly in a stock or index fund rather than $6,000 all at once. Dollar cost averaging works by investing through market price fluctuations. When you invest the same amount regularly, you automatically buy more shares when prices are low and fewer shares when prices are high. Dollar cost averaging offers several key benefits. It removes emotional decision making from investing, provides a systematic way to build wealth over time, and eliminates the need to time the market. Dollar cost averaging is ultimately a disciplined approach that removes emotions from investing and provides a systematic way to build wealth over time. By consistently investing fixed amounts at regular intervals, you can harness the power of compound growth and market fluctuations to your advantage. Let's compare dollar cost averaging with lump sum investing. Dollar cost averaging involves investing fixed amounts at regular intervals, while lump sum investing means putting all your available capital into the market at once. When comparing performance, we need to consider different market conditions. In rising markets, which occur about two-thirds of the time, lump sum investing typically outperforms DCA because more of your money is invested sooner. In a steadily rising market, lump sum investing often generates higher returns, as shown by this comparison. Since more money is working in the market sooner, the total growth potential is higher. However, DCA offers significant psychological benefits that often outweigh the potential mathematical edge of lump sum investing. DCA reduces regret risk, the feeling of remorse if you invest everything right before a market drop. It eliminates the pressure of perfect market timing, provides emotional comfort during volatility, and helps navigate uncertain markets better. While mathematical analysis often favors lump sum investing in purely rising markets, behavioral reality suggests that DCA is the better choice for most individual investors. The psychological comfort of DCA helps investors stick to their strategy during market turbulence, potentially avoiding costly emotional decisions like panic selling. For most individual investors, the behavioral advantages of dollar cost averaging often outweigh the potential mathematical edge of lump sum investing. To implement a successful dollar cost averaging strategy, follow these four essential steps. First, determine your investment parameters. Decide how much you want to invest and how frequently you'll invest, whether weekly, monthly, or quarterly. Second, set up automatic transfers from your bank account to your investment account. This ensures consistency and removes the emotional component from investing. Third, choose appropriate investments that align with your long-term goals. These might include index funds, ETFs, or individual stocks. Finally, take advantage of your brokerage platform's automation features. Many platforms offer tools to automatically invest your transferred funds according to your specifications. Let's explore your options for investment frequency. The right choice depends on your financial situation and investment goals. Weekly investments provide the most averaging effect and work well for smaller amounts. Monthly investing is the most common approach, balancing convenience and averaging benefits. Quarterly investing requires larger amounts but involves less maintenance. Setting up automatic transfers is crucial to maintaining your DCA strategy. It removes the temptation to time the market or skip investments during market downturns. Choosing the right investments is essential for your DCA strategy. Let's compare three common options: index funds, ETFs, and individual stocks. Most modern brokerage platforms offer automation features that make implementing your DCA strategy simple. Here's how a typical platform interface might look. When implemented correctly, your DCA strategy leads to consistent investment growth over time, regardless of market conditions. By following these implementation steps, you can create a disciplined DCA strategy that builds wealth consistently over time without the stress of trying to time the market. Dollar cost averaging performs differently across various market conditions. Let's examine how it behaves in three distinct market scenarios. In steadily rising markets, DCA typically underperforms lump sum investing. This is because you're gradually buying as prices increase, resulting in a higher average purchase price. In volatile or sideways markets, DCA helps smooth out returns. By investing consistently regardless of short-term price fluctuations, you avoid the potential pitfalls of market timing. In declining markets, DCA can significantly outperform lump sum investing. This strategy allows you to accumulate more shares at lower prices, reducing your average cost basis. To summarize, DCA performs differently across various market conditions. In rising markets, it typically underperforms lump sum investing. In volatile markets, it helps smooth out returns. In declining markets, DCA can significantly outperform lump sum investing by allowing you to accumulate more shares at lower prices. This makes dollar cost averaging particularly valuable when market direction is uncertain, as it provides a balanced approach regardless of short-term market movements. The real power of DCA is its ability to adapt to any market condition, helping you accumulate more assets when prices are low while still participating when markets rise. When implementing dollar cost averaging, avoid these common mistakes that can undermine your strategy. The first mistake is inconsistency in contributions. Successful dollar cost averaging requires regular investments at fixed intervals. As this chart shows, sporadic investments defeat the purpose of averaging your cost over time. You need consistent contributions to benefit from market fluctuations. The second common mistake is abandoning your strategy during market downturns, precisely when dollar cost averaging is most beneficial. Market declines actually present the best buying opportunities. This is when your fixed dollar amount purchases more shares, lowering your average cost. The third mistake is frequently changing your investment selections. Jumping between different funds or stocks disrupts the averaging process. Choose quality investments aligned with your goals and stick with them. Constant switching often results in buying high and selling low. The fourth mistake is using dollar cost averaging as an excuse to delay investing significant amounts for too long. While DCA helps manage risk, waiting too long to begin investing means missing out on potential growth. Early investors typically outperform those who delay, even with market fluctuations. Remember that dollar cost averaging is meant to be a consistent, disciplined approach. Deviating from your plan based on market news or emotions undermines its core benefits. Success depends on sticking to your strategy through all market conditions. Retirement accounts, such as 401ks and IRAs, naturally implement dollar cost averaging through your regular paycheck contributions. When you set up automatic contributions from each paycheck, you're practicing DCA without any additional effort. Retirement accounts offer three major advantages that enhance the power of dollar cost averaging. First, tax advantages. Contributions to traditional 401ks and IRAs are typically pre-tax, reducing your current taxable income. Your investments then grow tax-deferred until retirement. Second, employer matching. Many companies match a percentage of your 401k contributions. This is essentially free money that immediately provides a 50 to 100% return on your investment. Third, DCA benefits. The automatic nature of paycheck contributions enforces investment discipline and allows you to accumulate more shares during market downturns. Let's visualize how dollar cost averaging works in retirement accounts over a long time horizon of 30 years. With consistent contributions every 2 weeks or monthly from your paycheck, you're buying into the market at regular intervals, regardless of price. The magic of DCA happens during market downturns. When prices are lower, your fixed contribution amount buys more shares. This means you're accumulating more assets precisely when they're on sale. Over decades of consistent contributions, this combination of tax advantages, employer matching, and disciplined DCA investing creates a powerful wealth-building system. By maintaining steady contributions throughout your career, market volatility becomes your ally rather than something to fear. This approach typically leads to significantly better long-term results than trying to time the market. Dollar cost averaging has become especially popular for highly volatile assets like cryptocurrencies. Cryptocurrencies like Bitcoin and Ethereum experience extreme price swings, making them particularly challenging to time correctly. When using dollar cost averaging, you invest a fixed amount regularly, regardless of the current price. This approach helps mitigate the risk of buying at peak prices. While many investors try to time the market by predicting price movements, research shows this approach is rarely successful with volatile assets like cryptocurrencies. Dollar cost averaging, on the other hand, removes the pressure of perfect timing. It provides a systematic approach with a much higher success rate for long-term investors. Many cryptocurrency exchanges now offer automated DCA features. These tools allow investors to set up regular purchases without having to manually execute trades. Beyond the financial advantages, DCA helps manage the psychological stress of dramatic price fluctuations that might otherwise lead to poor timing decisions. Dollar cost averaging involves regular investments over time, which has important tax implications you should understand. With dollar cost averaging, each purchase creates a new tax lot with its own cost basis. This means that as you invest regularly over time, you acquire shares at different price points. A tax lot is simply a group of shares purchased at the same time and price. Each DCA purchase creates a new tax lot with its own cost basis for tax calculations. One advantage of having multiple tax lots is the opportunity for tax loss harvesting during market downturns. When the market drops, some of your higher-priced tax lots may now be worth less than what you paid for them. This creates an opportunity for tax loss harvesting, selling investments at a loss to offset capital gains while maintaining your overall market position. The tax implications of dollar cost averaging vary significantly depending on the type of account you're using. In taxable accounts, each DCA purchase creates a separate tax lot with its own cost basis, requiring detailed record keeping. However, in tax-advantaged accounts like 401ks and IRAs, these tax considerations don't apply since the accounts already have special tax treatment. For taxable accounts, keeping good records of all your DCA purchases is essential for tax purposes. You should track purchase dates, share prices, number of shares acquired, and the total cost basis for each transaction. These records will be crucial when you eventually sell shares and need to calculate your capital gains or losses for tax reporting. Many investors use different DCA strategies depending on the account type. For tax-advantaged accounts like 401ks and IRAs, a simple automated DCA approach is common since there are no tax implications to manage. For taxable accounts, investors often employ more active strategies, including tax loss harvesting and strategic tax planning to optimize their after-tax returns. The key is to understand how each account type affects your tax situation and adjust your DCA approach accordingly. Is dollar cost averaging the right strategy for you? Let's examine who benefits most from this approach. Dollar cost averaging works best for several types of investors. First, those who have regular income to invest, such as a monthly salary that allows for consistent contributions. Second, investors who prefer a hands-off approach and want to automate their investing process. Third, those who experience anxiety about market timing and want to avoid the stress of trying to predict market movements. And fourth, investors in volatile markets like cryptocurrency, where price swings can be extreme. However, DCA may be less ideal in certain situations. If you have a large sum to invest all at once, such as an inheritance or bonus, research suggests that lump sum investing might outperform in the long run. With a very long time horizon of 20 years or more, the opportunity cost of holding cash while waiting to invest incrementally may reduce your overall returns. If your primary goal is maximizing absolute returns regardless of risk, historical data shows lump sum investing has higher expected returns. And if you're comfortable with market volatility and can maintain your investment strategy despite market fluctuations, you might not need DCA's psychological benefits. When deciding if dollar cost averaging is right for you, consider these important factors: your personal financial situation, including your income stability, debt levels, and emergency savings. Your investment timeline, shorter horizons might benefit more from DCA's risk reduction properties. Your psychological comfort with market fluctuations. If market drops cause you anxiety, DCA can help reduce stress. And your overall investment philosophy, whether you prioritize consistency, risk management, or maximum returns. Dollar cost averaging is highly adaptable to different investor needs and can be modified to suit your specific circumstances. The bottom line is that for most individual investors, some form of dollar cost averaging proves beneficial, whether implemented strictly or as a hybrid approach with your other investment strategies.